Hi, everybody. We are here again with Christian Dye from Latitude West Financial. And we're just kind of extending our conversation from last time and touching base on some of the high tax bracket and high income earner clients and maybe what mistakes they may be making in the investment markets or sectors. Welcome.
Sure. Yeah. Thank you. So, I guess one question that's often asked of me is how the ultra wealthy invest, and why should people be investing like the ultra wealthy, especially people of high income earnings, such as doctors and dentists and lawyers. And I guess one thing I always say is they don't know what they don't know.
Right. Yeah.
And they don't realize a lot of the strategies that are out there for them. So one of the things is, because I come from an education background, I like to try to talk to them about, who are the ultra wealthy and how are they investing? And then the stronger question is, why don't we just invest like they do?
Right.
So the Tiger 21 is the first group that I'd like to talk about. And the Tiger 21 is it's a peer-to-peer group, so it's not an actual company that invests your money. These people are a group that they vet you to get in. I think you need a minimum $10 million as a minimum investment. But the average investor with the Tiger 21 has $135 million.
Wow.
So this is a group that's known worldwide, and their chapters around North America. And if we take a look at their asset allocation, it always hovers around kind of four buckets. So one that I'd like to highlight is public stocks,
Right.
and that's the equity market. Now, when I say that people should be investing like them, right now the majority of people have most of their money in just the public stock market.
Yeah.
So it will be in mutual funds and TFSAs, and maybe it'll be a 70-30 stock bond portfolio mix. And they think that's the way that they're going to create wealth.
Right.
And for a lot of people, this is what they're doing. But if the ultra wealthy are not doing this, then a bigger question is, well, then why are we?
Right.
And if we take a look at what they do, of course, they do invest in the stock market, but they have less than 30% consistently inside the stock market. Two other asset classes to highlight are the private equity market, and that's in the bottom right corner. Usually they have almost an equivalent in private equities. Which is something that the majority of investors don't invest in. And that's usually because they don't know how, they don't have access to it. And the people that are investing their money typically aren't licensed to do this for
Right.
them. But it's getting easier now. Probably about 5 years ago, you needed, like at least 100,000, in some cases $1 million to invest with this group. But now in the EMD market,
Right.
you do have access towards it.
And these are, like you're talking about REITs and those type of.
Not REITs. It could be one of those asset classes, but it wasn't the one I was particularly thinking of. And the reason why I don't think of it is because you have access to REITs in the public stock market
Right.
as well. But these things, a lot of them, you need to be a accredited investor for some of them. And for people who aren't familiar with that, a accredited investor usually needs to make a minimum of $200,000 per year,
Right.
and they sometimes need to have assets of $5 million.
Right.
So I guess for a high income earner, they usually would fall under this classification, but they don't realize that they have access to this. Right. But in your field over here, and that's that top left corner, is real estate.
Yeah.
And many of them do not have enough exposure to real estate in the form of not just their own home. I'm talking about investment grade real estate, rental properties, commercial properties, multi-units. And if you take a look at the ultra wealthy, this is the way that they're investing because it is a diversified asset class. And one that's often underlooked is the fixed income portion, and that's the bottom left. And they want a fixed income. It doesn't produce a lot of returns, except its liquidity. It's the
Right.
ability to pounce on the other three sectors when there's an opportunity. It's another way to, smoothen out the returns on the portfolio. Most people do not have, 20 to 30% of their assets in cash or some form of a fixed income because, of course, their returns would be quite low.
Right.
But what we could do is we could learn from this. The other group, which is one of the largest groups in Canada, is the Canada Pension Plan. I would consider them, again, high net worth, because they're managing billions. Well, if they're managing billions and they're getting a very, very good return, they're actually one of the best pension plans, one of the best pension plans in the world. They've consistently beat the S&P 500. Well, how are they investing? And if you take a look, it looks almost the exact same as the Tiger 21.
Right.
Very, very, very similar. So if the wealthiest investors on the planet are investing this way, and if one of the best pension plans in the world are investing this way, then the question is, why aren't we investing this way as average investors?
Right. What is wrong with doctors investing on their own?
Yeah, so that's like DIY investing, do it yourself. I have a lot of clients that are doctors and dentists. And what I'm finding is that it's very popular now that they invest on their own.
Right.
ETFs, index funds, Vanguard,
Like a Wealthsimple,
Questrade, Wealthsimple, absolutely. So when we ask, what is wrong with them doing that? So the quick answer is nothing.
Right. Yeah.
It's okay to do anything on your own. You can change your own oil if you want. You can write up your own will if you want. But what I often find is that they're making mistakes when they change their own oil.
Right.
They're making mistakes if they try to do their own will, but they're smart people.
Right.
And when they try to invest on their own, I think one of the big problems is, more or less, they're leaving opportunities on the table. They're leaving money on the table.
Right.
Are they going to retire on time? Yes. Are they going to have enough money? Yes. But if they saw what they could be doing, I think they would be shocked.
Right.
And so that's, I think, one problem. And so the second problem, I think, is where they're actually getting their advice from. So if they're doing it themselves, where are they getting their advice from? And from what I've heard, is a lot of it is from the internet.
Yes.
It's from, someone does a blog, or there's a Facebook group with other physicians or other dentists in there, and they're telling each other what they're doing. And they're highlighting a problem such as fees. Oh, you're paying way too much in fees. So they says, you're right, we could do this on their own. And now there's a Vanguard ETF out there that's getting great returns, and I'm only paying 0.5% MERs as opposed to 2.5%. And they think that, they could just do this completely on their own. But if we think of, again, we've mentioned it before, the wealthiest investors on the planet, like the Tiger 21. The Tiger 21, do they do ETFs, saving on fees, with the majority of their money? And the quick answer is no.
Right, yeah.
They don't. So if we look at sort of dissecting the Tiger 21, and I also compare it to the Canada Pension Plan, well, why doesn't the Canada Pension Plan just do Vanguard ETFs?
Right.
Why don't they just save on the fees? Why don't they do this?
Yeah.
And the quick answer is they get much, much, much better returns with a lot less volatility. If you do an ETF in the S&P 500, you are still victim to the volatility of the S&P 500, which is typically about 16% standard deviation.
Right.
The Tiger 21, which are the richest investors in the world, and the Canada Pension Plan do not want a 16% volatility.
Right.
And they both have long-term time horizons. So if you look at the dissection, right away, what the doctors should be doing is, if they're comfortable investing on their own, they should be investing in the top right-hand corner on their own, in the public stock market.
Yeah.
But they should not be putting all of their eggs in one basket. If they want to, not leave so much money on the table, they really should be in the bottom right-hand corner, be doing private equities. And in the top left-hand corner, they should be doing real estate.
Right.
And this is in your neighborhood, like investment real estate. And in the bottom left corner, they should understand the best type of fixed income. Because most of these guys are incorporated, and these guys are really, really, really don't understand the tax implication, of what they're doing when they're investing. So I think that's one of the reasons why they're going to get a decent rate of return, but at the same time, it's going to be nothing of what they could. A lot of them are incorporated, and the majority of their money is inside of a corporation.
Yeah.
Now, they don't understand the tax implication. They don't fully understand the tax implication of when that money needs to come out.
Yeah.
Yeah.
Yeah. That's a big thing. I mean, all my stuff is pretty much in corporation too, probably similar setup to a lot of physicians. And it's changing, right? Like the capital gains portion has changed within the corporation. And so you need to kind of know what it costs you to take the money out and, you know, all of that, those factors.
Yeah, absolutely. And I think that like when they're getting advice from friends, they're getting advice from people on podcasts that they've never even met.
Yeah.
I kind of find that that's the equivalent of them getting advice from someone who, it's like getting medical advice off of the internet.
Which I've tried, by the way. Hey guys, getting better.
Yeah, and how's that bum leg of yours working out?
Sorry.
Yeah. And so I kind of find that investing shouldn't be a hobby.
Right.
And that's almost how they're treating it. And why are they treating it like a hobby? Because they feel that they're saving on fees. But in actuality, use the top right-hand corner as the hobby and then get professional help in the top left and in the bottom right-hand corner. Right. I think that's the number one reason why they don't realize that with what they're doing, they will likely hit a point where they're very comfortable and they can help themselves to a wonderful retirement and, you know, help to give it a helping hand to their children.
Right.
But at their income tax bracket and in their level of wealth, they're leaving a lot on the table. They have the opportunity with, let's say, a 30-year career and their income level. They have the opportunity to build a massive amount of wealth, set up generations, set up charities, set up, you know, in incredible institutions. Like I have clients who are not doctors, who have okay income, and they're worth more than like, you know, over $20 million, $30 million. Right. The majority of that money was not made in the public stock market. It was actually made in the real estate market. Yeah. And they don't understand how this formula of the 4 quadrants can be used in order to fuel much, much, much larger returns.
Interesting, yeah. And like you say, a lot of people are listening kind of to their friends or what they see online, or they get, you know, stock tips, so-and-so did this, and it's hard. People want the fast returns too, you know, so sometimes people just want to invest in one asset class because they feel, you know, so-and-so did it and they had good experience. But I think, this is a good,
I think there's a herd mentality.
Yeah, there's a herd mentality.
They don't want to get away from the herd. And when the herd is all doing ETFs, investing with, you know, Vanguard or with Wealthsimple, whatever it happens to be, they say, well, the herd is going in that direction, so I must go in that direction. But if we stop and say, what are the wealthiest people on the planet doing?
Right.
Why am I going with the herd when why don't I just do something a little bit different? And of course, you as well as I have built a lot of our wealth in real estate. Yeah. And for us, our herd is different. Right. We take a look and our numbers are much, much, much different as well. And so I feel that trying to do it yourself, the problem is you will be getting some very, very, very biased advice from your peer group. Right. And I think that's dangerous. In and of itself is dangerous because the tax laws are changing and they're directly affecting that group in particular. Why
do doctors and other incorporated individuals have a false sense of wealth?
Sure. So I often talk about this with this idea of a false sense of wealth because right now in Canada, it is very popular for high-income earners such as doctors and dentists to incorporate their practice and then be paid their gross income through there, and then they'll take out either a salary or a dividend in order to lower their tax bracket. And now what's popular as well is they will, whatever amounts that they're able to leave in, they will invest. Okay. And when they look at this number, they said, wow, look how much I'm saving on taxes and look at how much this is growing. But I always think that they have a false sense of wealth because of their lack of diversification. So one of the things that I want to highlight here is what does it look like, you know, when they invest corporately? whether they do this on their own or whether they use an investment advisor. And something very, very popular might be, let's say they do it on their own and they're investing in ETFs, a 70% stocks, 30% bonds. I'm going to use the case example of annual contributions of $200,000 per year. Mm-hmm. So what that means is that they're able to leave $200,000 per year inside their corporation. A physician typically might make, let's say, $500,000 a year. Mm-hmm. They could leave $200,000 inside, and then they're paying taxes, and they're living off of the leftover. So they think, okay, I'm going to leave $200,000 a year, and I'm going to do a stock bond portfolio. Let's say their stocks gain 9% annually. Let's say the bonds gain 5% annually. What we notice is what they don't realize, and this is why I call it a false sense of wealth, is they don't really understand how much taxation they're going to have to pay. Mm-hmm. So it's double taxation. They're going to pay taxes on the gains that the investments make inside the corporation, and they're going to pay taxes again when they try to pull the money out, either to live off of it or to pass it to their heirs. And the inclusion rate that changed in June of 2024 changed the amount of taxation, which make the capital gains. So there's something called a CDA credit. It stands for the capital dividend account inside of a corporation. And that's the amount of money that can flow out tax-free based off of the investments. So it went from 50% to essentially about 32%. Okay. So now the amount that can flow out is only about 32% of that capital gain. So what I've done is kind of, broke it down from a yearly basis, year 1, year 5, year 10, year 15, year 20, using this model. $200,000 per year being invested corporately with a 70% stocks, 30% bonds, stocks gaining 9, bonds gaining 5. And I think what's the highlight is this last column. What percentage is lost to taxation? And what we notice is, year 1, we're losing, about 40% to taxation if you were to invest it and pull all the money out. Year 5, you're losing 42. Year 10, you're losing 44. Year 15, 45. Year 20, 47. But what we're noticing is the longer you keep the money in, the more you're actually losing to taxation, unless, of course, they change this 20 years down the road or 30 years down the road. But we're losing almost 50% of the value of our assets inside of corporation. And so that's why I say there's this false sense of, they think they're going to end up with all of this money, but all of a sudden that they're not. Right. And you sort of said, well, is there a solution to this, or are we just victim to it? And again, this is that false sense of wealth. They don't really understand what's available to them. And we've talked about this group before of the Tiger 21. They must do the same thing. They must have a way of minimizing taxation. And it's because they have 4 different asset classes. So they do have, public stocks, but they don't have more than 30% inside of it. But there are certain private equities that have much higher returns that are completely non-correlated. And then there's real estate. Now, the beautiful thing about real estate, and this is kind of your field of expertise, is there's multiple tax deductions with real estate, even inside of a corporation. There's the interest that you could deduct, the property management fees you could deduct, any expenses that you could deduct, and there's the leverage behind it, which is also deductible. So what I find is that when they diversify out, what they can do is have way, way, way less taxation on their investments, and especially if they utilize things like the fixed income. Like what we do in our practice is we actually invest in products for our clients that actually build CDA credits. Mm-hmm. So if their investments in the stock market, in the real estate market, and in the private equities are doing really, really well, we have a second problem. How can we tax efficiently get them out of the corporation? And that's where we'll need these CDA credits. So for them who are, essentially sticking to a very, very standard, why don't I just invest in a stock bond portfolio? then what they're going to have is a very, very rude awakening when they realize, okay, how much taxation have they actually calculated the taxation coming out? And you'd think that the accountant would help with this. The accountant is going to calculate the taxation of whatever investment strategy they do.
Right.
They're not financial advisors in the form of saying, you should invest in this, you should invest in that.
Right.
That's what the advisor is there for. And then what we're finding is that a lot of these guys are actually investing on their own. So that's problem one. They're investing on their own. So when they invest on their own, they're getting advice from, peer groups on the internet, and they're saying, do ETFs. For example, save on the fees. And then if they are working with a financial advisor, they're often incentivized to put them in, mutual funds or, very, very similar, also stock-based vehicles, whereas they would be significantly better off if they used the model of the Tiger 21. And this model is one of a diversification. Now, where they need help is probably in the areas of the real estate, the private equity, and the correct fixed income. When I think of fixed income, they might think, oh, do you mean like bonds? Bonds are one of the worst things that you could put in your corporation because they're taxed at 51%. Right. Stocks are roughly around 27%, depending on which province you're in. But working with a team that actually understands this mix, working with a team that could help to advise you on the other three areas aside from just the stocks, that's how you could minimize that tax bill. That's why you can actually create, real wealth inside, as opposed to being victim to losing, in the neighborhood of, 47% in taxation.
Right. Why should high income earners be investing in private equity versus stocks?
Sure. That's often asked to me because with a lot of our clients, we deal with a lot of high income earners, a lot of physicians, a lot of dentists. And they often, when we give our recommendations to diversify out of so much in the public stock market, they often ask, why? And then one thing that we sort of fall back on is how the wealthiest investors invest, so like the Tiger 21.
Yeah.
So when we look at the Tiger 21 and compare it as well to the Canada Pension Plan, which we've talked about before, we notice that less than 30% of their assets are in the public stock market.
Right.
And what they do is they have almost an equivalent amount in private equity. And then we've talked about before the reasons to invest in real estate and the correct type of fixed income, which builds up CDA credits. Right. But why private equity as opposed to and not just public stocks? Well, if we were to take a look, one of the things is to understand what Tony Robbins is doing. Tony Robbins wrote a book recently called The Holy Grail of Investing. And Tony Robbins is looking at what huge hedge funds like Ray Dalio's hedge fund, what they invest and why they invest in it. And a big takeaway from that book is, number one, is that you should always have non-correlated assets inside your portfolio, such as real estate.
Right.
And this doesn't mean REITs. This actually means direct ownership real estate.
Right.
But he also highlighted how so many people are investing inside the stock market, and a lot of them are doing it on their own, but they don't realize that in private equities, it's historically actually beat out the stock market. So, for example, he did a study from the last 40 years, and he found that on average, the S&P 500 has returned 9.2%. And then a lot of people who invest on their own will probably agree with this. What they don't realize is that on average, the private equity market has outpaced this at 14.28%. So that's almost 50% more. Wow. Just to give you the magnitude of the public stock market versus the private equity market, if you had $100,000 over a 30-year time frame at 9.2, you'd have 1.4 million. Wow. If you had $100,000 in a 30-year time frame at 4.28, you'd have 5.5 million. Wow. So if you take a look at these hedge fund managers such as Ray Dalio, you could understand, why do I need to be invested in the private equity as well as the public equity? And what I find a lot of people are doing, especially the do-it-yourselfers, is they're going and they think they're making a ton of money by saving on fees by investing in something like Vanguard. You know, like a Vanguard ETF, and this over here is a balanced Vanguard ETF. Some of the things to notice, on a 10-year average return, it's yielding about 8.13.
Wow.
But if you look at 2023, it returned 17%.
Yeah.
If you look at 2021, it returned 14%. If you looked at 2020, 16, 2019, it returned 21. So then you sort of ask yourself, these are incredibly strong returns over here. Why do I need to diversify? Right. Why do I need to get a financial advisor to help me to invest? Because if you stretch it over a long period of time, these types of investments are completely victim to the public stock market, which is incredibly volatile. You get the double-digit negative years as well. Yeah. Where if we take a look at private equity, and I'm going to show an example over here. So this over here, and I'm not going to release the name of it, but this over here is a sample of one of our private equities. And there are lots of private equities out there, but people just don't have access to them. They don't understand the numbers. They don't even understand how they would find them. And one of the reasons is because if they even did try to find it on their own, you don't know. It would be like a part-time job. Whereas if you just work with an investment firm, like here at Latitude West, we are private equity licensed. It's called the EMD market. So we want to have exposure to this. So a couple of things to highlight here is the returns are actually very consistent. We don't get the crazy volatility, but at the same time over here, we're achieving those, low double-digit returns that we want to get for our clients, but at the same time, they're not correlated to the public stock market. So there are three main reasons why I would say, why should high-income investors be investing in private equity as well as public stocks? Number one, it's not correlated to the stock market. Right. Number two, historically they've had higher returns. And number three, like many financial planning books are saying, you want to diversify your assets. You don't want them all victim to one asset class.
That's interesting. I mean, some of the private equity stuff I have that you put me onto as well, I think part of it is for people, like in a stock, you can see day to day what the trades are. And I think the thing to get your mind around for some of the other investments, like, I get a statement every 3 months and it's doing well. But I think some people, it's hard not to see that every day. This is what my investment is at. Yeah. But then when I get my statements, I'm like, okay, everything's good. But
yeah, like I almost feel that you're also with private equity, you're less likely to try to day trade it. You're less likely to try to get in and out on a weekly basis. It really is more of a long-term investment, which is what we always encourage for our clients. But I do think that the society is shifting a lot more to the what's exciting now. What's kind of exciting now. And a lot of these private equities are not exciting at all, to be honest. Right. They're very, very boring, but the long-term returns are fantastic.
Boring is good long-term.
Boring is good, yeah.
Why should doctors invest in real estate as well as stocks?
Sure, that's a great question. With the clientele that I have, a lot of them are doctors. And what I tell them to do is I tell them to not put all their eggs in one basket with those stocks, whether they're, investing on their own or investing through me. And then, of course, I'm very, very real estate-based financial advising company. And I sometimes have to convince them why they need to invest in real estate. Right. So a couple of reasons is because if they invest just in the stock market, they're incredibly, incredibly limited. Number one, you can't leverage. Right. And, of course, there's this amplification with leverage. So we call it the 5-to-1 rule. If I have a $100,000 down payment on a $500,000 property, if it goes up by 10%, that's $550,000. Well, off of my $100,000 down payment, I now have a 50% return. So that right. So that's 5-to-1 rule. And because a lot of doctors have the time, if they're young and they just finished residency, for example, they have another 30 years of work life, right? A real estate property is paid off in 30 years, right. Yeah. And so what we realize here is that they've got this fantastic opportunity to take advantage because they have the time inside the real estate market. Plus, of course, usually lending's not an issue because of their high income. And they have the cash. A lot of times it's inside their corporation, but then you could invest it inside your corporation. You might have to set up a holding company. But some of the wealthiest people I know, not just doctors, people I know, all have large amounts of real estate, and they don't even have the high income. So the second reason why I think doctors should be investing in real estate is because they don't have pensions.
Okay.
So because they don't have pensions, when they retire, if they just had their stocks, then what they'll do is those stocks will slowly start to deplete because they need to live.
Right.
They need to live off of that. And so it could technically deplete down to nothing.
Right.
Whereas real estate, you have something different. You have rents. So now, if you keep building and stacking a real estate portfolio, you most likely will have enough rent to never have to sell the real estate.
Right.
And even if you did sell the real estate, you don't have to sell all of it. You might just sell a piece or a piece at the time. The third reason is because of taxation. Okay, if I invest purely in a stock portfolio inside my corporation or even personally, what tax advantages are there? Not a lot.
Right.
Sure, RSPs, but for a doctor, they'll blow through that pretty quickly.
Yeah.
But when you have real estate, okay, I could depreciate the property. I can deduct the interest on the mortgage. I could deduct any property management fees. I could deduct capital expenditures. Capital expenditures add value. So I'm adding value while deducting the cost.
Right.
And so there's all of these different advantages of real estate, especially for high income earners who are already victim to high taxation. And especially if they don't have something like a pension waiting for them, then all they have is their stocks, which will deplete down. And if society keeps going the way that it's going, maybe even with AI, I'm hearing some crazy things about AI, how it's going to improve our healthcare. We might no longer have an average life expectancy in the 80s. We might have it pushed into the hundreds. So if we add just another 20 years to our life expectancy, you're going to want real estate even more.
Right.
Because what happens with real estate, over time, it appreciates with inflation and beats inflation. Whereas what happens with a stock portfolio is, if I retire with a stock portfolio, you're not going to be able to take the risks. You're going to actually reduce the rate of return down.
Right.
And now start depleting it. Well, if we were projecting out a 20, 25-year retirement, which is now closer to 35, 40-year retirement, you might run out of that money even faster. So why does real estate solve a lot of those problems over here? If I'm sitting on multiple real estate properties by the time I retire, rents are just going to be higher as time goes on.
Right.
The rent that I generate from the real estate on the day I retire compared to 10 years later, the rents will even be greater. The asset value will be even greater. I'll have even more options of what I could do with that real estate. And of course, you and I, both investing in real estate, we understand this concept.
Yeah.
And you and I also not having pension, understand the need for it.
That's crazy. I didn't realize that doctors, I think you said dentists too, don't have pensions. I thought they did.
No, they're pretty much, you might almost consider them sole proprietors.
Okay.
So they're actually being paid through the hospital.
Right.
Or through their
the
dental practice. The nurse that is assisting them on the surgeries, she's got a good pension.
Wow.
The teacher's got a good pension. And the thing is, the nice thing, anyone who's listening, whether they're a doctor or anyone who's self-employed or has their own business, they should adopt this philosophy of integrating the real estate for all of these same reasons.
That's why my doctor at the clinic rushes me out then, because he needs to see how many people a day, because there's no pension.
Trust me.
I totally didn't know that. That's interesting.
And so anybody who's got, an incorporation should really, not even incorporation, but anyone who can afford to diversify into real estate should absolutely do it. And I'll give you another reason why, and this is more of just raw numbers. They're leaving money on the table by just investing in the stock market.
Right.
Whether they're doing themselves or doing it with someone else. So I'm going to take an example. I'm not going to say where this is. I'm not going to give you any details beyond, who bought this. But we have a 16-plex, and we helped a client with this. And remember, we're fee for service, so we're not realtors. We can't actually sell any of this stuff. We're just helping our clients to grow wealth. So this 16-plex, which is not in BC, it's about 4.48 million, and it's 16 units altogether. If we look at the numbers over here,
That's pretty good.
we were able to get this thing to cash flow over $2,000 per month. For those of you who understand real estate, it had a capitalization rate of 4.91, which is a fantastic cap rate. But if we just compare this to the stock market, this piece of real estate is going to give us 19.91% annual return over a 10-year period. And why is that?
Right.
Well, we were able to help them to find this property, but using a specialized program in Canada, we were able to get them as little as 12% down payment. Now, with that 12% down payment, if we take a look at the exit of the numbers, this person was not planning on holding this property forever. So we had a 10-year plan for our client. It was about a $600,000 investment. But when they exit in year 10, they should make about $2.4 million.
Wow.
So right off the bat, if we calculate it, it's close to a 20% rate of return. Automatically, and they don't have to exit. They absolutely don't have to exit. But if we look at year 1, they're getting cash flow of almost $30,000. In year 9, they're getting cash flow of $88,000. Now, if they sell, they're going to get, $2.5 million. But if they don't sell, they can actually achieve, over $80,000 a year in cash flow off of this property. Now, I don't know of any stock that can do this. And right away, if this isn't a strong enough argument why they should be investing in real estate, the larger question then becomes, where can I find this property? Right. Like, how do I find a deal like this? Deals, yeah. And then it goes back to, are you an investor doing it yourself? Because if you're doing it yourself, you probably won't be able to find it. Mm-hmm. And if you are working with an investment advisor who's solely investing in the stock market, well, that person's not going to help you to find it as well. It kind of defaults to, are you working with the right team? If you believe in integrating real estate, you should be working with a financial planning group such as ours, Latitude West, which actually promotes real estate, helps our clients to find it as well.
Yeah, I mean, it's a good point, because I can say as a realtor in Vancouver, it's harder to get cash flow, especially like this. So it's good to have those connections, outside of province as well for these opportunities.
Yeah, absolutely. And just a reminder, we're not realtors ourselves. Right, yeah. We're a team that's helping to build wealth, but also helping to preserve it.
Can you give us an example of a doctor who's had a false sense of wealth?
Sure. So I talk about this idea of false sense of wealth with high income earners. It doesn't have to just be a doctor. But what they find is that they feel that because they're making a lot of money, they have a lot of cash flow, and they're buying, they buy nice cars, they eat in nice restaurants. And here in Canada, many of them incorporate, they leave money inside their corporation. So the reason why they run into a little bit of trouble is because of taxation, first of all. But also it's because they don't really realize what else was available to them. So an example that I want to give, there's two examples. One of them is a physician. Of course, I won't name any names over here. He's older, though. He's now in his mid-70s.
Okay.
And when I once asked him, and I said, can you give me some advice? Because I work with a lot of doctors and I'm doing these presentations. Can you give me some advice of maybe some things you did right and maybe some things that you did wrong? And one piece of advice that he said, well, actually a couple of pieces of advice. One piece of advice was to marry the right person. And the reason why he said that is because he's divorced.
Oh.
And his income and his assets have been split. So he's got to work so much harder for just essentially half. So he said, the greatest investment I could have made actually was in my first marriage. Right. So that's good for just anyone's piece of advice. But a second one that he said was when he talked about not only that mistake, another mistake he had made was that a colleague of his, who's also a doctor, had approached him in the late 80s and said, I have an opportunity to buy an apartment building, and it's in downtown Vancouver.
Wow.
And then he said it's like a 60-unit building. And then he said, but the bank says I can't afford it on my own. I don't qualify on my own. But he says you can easily qualify if you had someone else making a similar income.
Okay.
So what ended up happening? So he approached him because they were friends. They were friends from medical school. And they says, if we go on this together, we could buy it. He says, well, how much is this thing? And this is late 80s now. He says, it's $1 million. It's $1 million building, and it's like 60 units in downtown Vancouver. And so he said, I don't know anything about this.
Right.
Like, I don't know what I'm doing. And back then, they didn't call them financial advisors; they call them stockbrokers.
Oh, yeah.
So he says, I'm going to talk to my stockbroker about this because I'm going to have to sell some stocks.
Right.
If we were to do this. And of course, what do you think the stockbroker said?
Yeah. Oh,
don't do it.
Yeah,
because the thing is, I think it would have depleted at least 60% of his stock assets in order for him to purchase this thing. And then the first doctor basically said, are you in or are you out? And he says, I'm out. I just want to practice medicine. I want to keep life simple. I don't know what I'm doing. And my stockbroker said, don't do it.
Right.
So he went to someone else. He went to a friend of his who was a dentist, actually. And they're the ones who ended up buying it together. Wow. Now let's fast forward to today.
This building's now the Shangri-La.
So it's still a rental building. I'm not going to give the address or anything like that. But he said the building's worth about $45 million.
Oh my gosh.
It's worth about $45 million. But not only that, he said that his doctor, who's his friend, says that he retired years past. And he said that he gains something in the neighborhood of around $25,000 monthly in rent. And the building's paid off.
Right.
The building's completely paid off. So I use this as my first example of this sort of a false sense of wealth.
Right.
So this one physician that I know is actually still working in his 70s. And I asked him, do you really enjoy working? And his quick answer was, I have to work.
Right.
I didn't want to press any further than that. He says, I have to work. But if I think about, well, what was the real mistake made? And I think it was very biased advice that he was getting. There was a lack of advice. There was a lack of education. And of course, as you know, you and I are both real estate people. We think that you should buy more real estate. But the only thing is, are you getting the right advice? I'm not saying you should buy any piece of real estate.
Of course, yeah.
But if you had that correct advice, so I know with my practice over here, you know, we kind of have this 4 quadrants in my practice. So our traditionally, absolutely, we do investments, traditional investments, and we're insurance licensed. But what makes us more unique is the planning, which is why we're fee for service. You don't have to do any insurance. You don't have to do any investments. But if you want that specialized planning, especially if it involves real estate, we're there to help you to see, is this decision that you're about to make? I know I've worked with many physicians and dentists who were buying a practice together, like a physical space together. They said, well, we have this opportunity to lease. We have this opportunity to buy. We're not sure if this is a good idea. And then me and my team can know. We're not sure how to structure it. How should we fund it? Should we cash out? Should we use a line of credit? Should we get finance it 100%? And so right away, I feel that this idea of getting specialized help is what the majority of them need, but they also need it non-biased specialized help. And that could help to see, do you actually have as much wealth as you think you have, or is there another strategy out there?
How do you add the most value then to your high income earning clients?
Yeah, no, that's a great question. So we deal with a lot of clients who make, significant income. We work with a lot of doctors, a lot of dentists. And oftentimes we find that a lot of them might be investing on their own. So they'll come to us and say, hey, I'm investing on my own now. What value do you bring that other teams might not be able to bring? So one of them is I describe what our practice is like. And if we look at these 4 quadrants here, We do a lot of the traditional things, such as, of course, we're investment license, RSPs, TFSAs, non-registered. We're insurance license, so we can help them with their insurance or insurance strategies, either inside the corporation or outside. But I think one of the greatest values that we add is we give them a second opinion with what they're doing. We don't charge them for the second opinion. And we basically say, this is what we believe you should be doing. And the majority of our clients, if they want to diversify into real estate, then we're often the team to work with.
Right.
Because real estate is our main focus of growing wealth in our practice. So the right-hand side of the quadrant is what makes us most unique. And then what we do is we help to show them, well, this is what it looks like with your life if you just invest without real estate. Mm-hmm. And this is what it will look like if you invest with real estate. Now, if they're already investing in real estate, we will actually show them a diversification of even more real estate outside of the geographical area that they're familiar with.
Right.
So we're based here in Vancouver, but a lot of our clients have no idea how to invest in multi-units in Saskatchewan, Alberta, in the US, or how to buy a commercial building. You know, we actually get them to think much, much bigger. And they don't realize, they don't know what they don't know. Right. They don't know that they actually have access in order to do this. You know, if I have, clients who are, not making as much money, then we're literally talking, high school teachers, and they're investing in multi-unit buildings and they're building multi-millions of dollars of wealth, then there's no reason why a higher income earner shouldn't have the exact same access. So what I often say is take a look at what other teams can offer you. And what other teams often offer are diversified portfolios. Instead of getting you an 8%, we can get you a 10% rate of return. We can, give you tax advice. We can give you the different types of advice. Well, if that's all you're looking for, then I'm sure there's multiple great teams out there. But for us in our practice, we're doing something very, very different. We're incorporating real estate and seeing how it can expand. So the question is, why real estate? Well, if we look at the Tiger 21, the Canada Pension Plan, these are the wealthiest investors on the planet. The average $135 million is how much each investor has inside the Tiger 21. Look at how much exposure they have to the stock market compared to the real estate market. It's very, very similar. Right. We've always said you should not have everything in just the stock market. We help with the real estate component. We help with the private equity component. We help with the fixed income component. We find what they can do on their own is typically on the right, the top right. All of the public stocks, ETFs, index funds, they could actually do that on their own. And many of our clients do it on their own. It's the other three quadrants that they need our help with. That's how we add the most value. It's the real estate that they don't have access to. It's the private equities that they don't fully understand or have access to. And it's the fixed income, especially if they're incorporated, the one that builds CDA credits. And most of them don't even understand what that even means. But so they can usually do 1/4 of what they should be doing completely on their own. And that's what I like to say is the greatest value that we can give. Now, when we think about why the Canada Pension Plan and why the Tiger 21 are investing this way is because they consistently beat the S&P 500. They consistently have lower volatility because of this diversification mix. So, for our high income earning clients, such as the doctors that we deal with, we show them this model. And if they want to continue to invest in the top right-hand corner on their own, that's fine. We will just help them with the areas that they don't fully understand. So I'm going to give you an example of a piece of real estate. So if you think here in Vancouver, which of course you are is your neighborhood, think of what a $715,000 property can buy you here.
Not this, yeah.
Yeah, maybe a 2-bed.
Yeah, you're lucky if you get 2-bed. A lot of it's going to be, newer stuff is like a 1-bedroom or.
Perfect.
Mom and dad, yeah.
Now, the doctors and dentists and high-income earners, they have access to that same stuff. Right. They have access to that 2-bed. If they decide to go out of province, maybe they could find this same house out in, Winnipeg or Ontario or somewhere else, and maybe so that those are the parts they could do on their own. What they can't do on their own is find these very, very specialized deals that we have relationships with investment-focused real estate teams as well as builders, which will never hit the internet. They will never hit the public markets over here. So $715,000, 2-bedroom condo, maybe in Vancouver or Burnaby, and maybe that'll generate $2,800 a month, maybe $3,000 a month, something like that.
In that range.
Well, if we dig into the numbers over here, and if we look a little bit closer at our numbers, we're able to. This is a real case scenario that we helped our client with. It was close to $6,000 a month in rent.
Wow.
It ended up having a rate of return in the neighborhood of 20% annually per year. The stocks aren't going to give you 20% annually. It had an outrageous capitalization rate of $7.8 million. And this was based off of 20% down payment, which of course, everyone has. Now, how are we able to generate this high amount of rent? Is because we had a relationship with a corporate company, that was local that needed this for their people, and they had, I think it was a 3 or 4 year lease. But the idea behind that is that what is the value that we're able to add from a non-biased perspective? So to remind you, we're not realtors. We can't sell any of this stuff. Right. But what we are looking for is being able to give a second opinion, be able to give alternatives of what they're doing, and show them, if you were to, work with us, these are the types of things that we can add to what else you're doing, let's say, for your stock portfolio. So if we take a look at the exit of this particular deal over here, look in the far right corner. If they decide to exit in year 10, they'll get a 24% rate of return. They will have invested $162,000. Yeah. That's how much they will have invested. They're looking at an exit of over $600,000 in year 10. In year 20, they're looking at $1.5 million. So it's not saying they have to own this property forever and then have to pay a 30-year mortgage. No, they could exit it based off of our assumptions and based off of the rents that we're getting for them. And what we're finding is that this is the value. This is what we like to call lift. Right. This is the greatest amount of value because we want to help them with the areas that they cannot do on their own. We are fee for service, but many of our clients like that. They like that there's no other hidden agenda. It's much like an accountant or a lawyer. I pay them a fee, and there's a very, very specific thing that they're going to do for me. And that's what we're trying to do for our clients. We're trying to add this value. We're trying to add this lift, give them the second opinion for what we're doing. So we don't charge them for this second opinion. We take a look at their profile, and if they don't want to do anything with us, they don't have to. If they want to do something with us, then we, of course, will correlate to an appropriate fee depending on what it is they want from us.